Hey everybody, welcome to Mortgage Today for Thursday, February 22nd, 2024, and oh, what a day it was. UMBS were down 6 basis points bright and early, but most of the day was a reaction to yesterday and a little bit of new data. Bonds were already leaking into slightly weaker territory ahead of the data and have popped to new highs afterwards. This report isn't the biggest market mover, but this week's installment is one that lines up with the survey week for non-farm payrolls. As such, it tends to get a bit more attention. Jobless claims came in at 201,000 on a 218 forecast, 213 previously, so staying strong. Continued claims came in at 1.862 million versus a 1.885 forecast. Yesterday, we got Fed minutes. Some highlights were that a couple of the policymakers pointed to downside risk from maintaining an overly restrictive stance for too long, which is kind of new. Fed officials also judged policy rate likely at its peak for the cycle. Saw the risk of inflation progress could stall. Most officials noted risks of cutting too quickly, and some policymakers said that slowing the pace of the balance sheet runoff could help smooth transition to ample levels of reserves. We also had a lousy 20-year bond auction yesterday, which has weighed on rates. Dealers were forced to buy 21% of the bond sale. The bid-to-cover ratio was a weak 2.39 compared to an average ratio of 2.63. And we also got the tail was 3.33 basis points, the largest on record. Foreign investors turned up their noses at this issuance. Bonds only had a small reaction to the stronger jobless claims data, despite the reference period being the same as the NFP number. Traders were more interested in the lower price pressures reported on the S&P PMI data. This suggests that a certain level of receptiveness to some of the other second-tier data may offer a counterpoint to the most recent CPI. But this assumes the data is friendly in the first place. Even if it proves to be friendly, we're waiting for at least a week of the first candidate PCE, which is next Thursday, and another week beyond that before any top-tier data. In the meantime, bonds are set adrift and not the fun kind. UMBS ended the day up 3 basis points, which is basically flat, so ending at 100.13. At least it's above 100, but it's put us between all these trend lines. We got two Fibonacci's. We have a 200-day moving average, as well as the 100 and the 50-day moving averages above us. And really only that 100-day moving average, which is the purple line, is support. We also got news today that the FHFA has implemented a new tool to keep delinquent borrowers in their homes. This tool is called a payment supplement and can lower a borrower's monthly payment by up to 25% without modifying the mortgage. This is intended for borrowers that have a rate lower than market. Servicers permitted to make a partial claim, meaning that the FHA will pay for part of this, and it'll help keep their mortgages current.